Good afternoon. Since the September meeting of the Monetary Policy Committee, global economic conditions have remained weak and global inflation low. Central banks in advanced economies provided more monetary accommodation, helping to ease global financing conditions, but further easing appears less likely. Downside risks from the heightened trade tensions and geopolitical developments remain. Despite a rebound in local GDP in the second quarter of this year, indicators suggest that economic activity will remain weak for the rest of the year. Recent monthly inflation has been lower than the midpoint of the inflation target range, as owners' equivalent rent, food and services inflation remain subdued. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 3.7% in October. Goods price inflation was 3.1%, while services price inflation remained at 4.2%. Food and non-alcoholic beverage price inflation slowed to 3.6%. The bank's measure of core inflation, which excludes food, fuel, and electricity, remains unchanged at 4%. Producer price inflation for final manufactured goods decreased to 4.1% in September. The medium-term inflation outlook is largely unchanged since September. The inflation forecast generated by the sub-quarterly projection model is unchanged compared to September, averaging 4.2% in 2019, 5.1% in 2020, and 4.7% in 2021. Headline inflation, CPI inflation is expected to peak at 5.3% in the first quarter of 2020 and settle at 4.5% in the last quarter of 2021. The forecast for core inflation is lower at 4.2% in 2019, at 4.5% in 2020, and remains steady at 4.6% in 2021. Food price inflation continues to surprise to the downside on a monthly basis and is expected to peak at about 6.1% in the third quarter of 2020. Inflation expectations continued to moderate gradually. According to the Bureau for Economic Research, third quarter survey, expectations for headline inflation are down slightly for 2019 to 4.6%. Expectations for 2020 remain unchanged at 5% and eased from 5.2% to 5.1% for 2021, reaching the lowest level since 2007. Five-year ahead inflation expectations also decreased to 5%. The inflation expectations of market analysts in the November 2019 Reuters Econometer survey remain unchanged at 4.3% for 2019, revised lower to 4.7% for 2020, and are unchanged at 4.8% in 2021. Market-based expectations implicit in the break-even inflation rates, that is the yield differential between conventional and inflation-linked bonds, have moderated somewhat since the previous MPC. Five-year break-even rates are currently about 4.5%, and 10-year break-even yield rates are at 5.4%. Global GDP is expected to average 3% in 2019, rising to about 3.4% in 2020. While trade and manufacturing indicators continue to be weak, services have remained more resilient keeping overall global growth rates up. However, services have shown weakness in some regions, and a range of downside risks to growth remain. These include geopolitical developments, trade tensions, further oil price shocks, and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Barring significant shocks, monetary policy in major advanced economies will remain accommodative over the medium term. While global financial market sentiment has turned more positive in recent weeks, the risk of renewed market volatility remains high. Since the September MPC, the rand has depreciated slightly by 0.6% against the US dollar and by 0.8% against the euro. The implied starting point for the rand is 14 rands 94 against the US dollar, compared with 14 rands 88 at the time of the previous meeting. While the rand has benefited from improvements in global sentiment, investors remain concerned about domestic growth prospects and fiscal risks. Although GDP growth rebounded to 3.1% in the second quarter, longer-term weakness in most sectors remains a serious concern. Based on recent short-term economic indicators for mining and manufacturing sectors, the third quarter GDP outcome is expected to be weak. Public sector investment has declined. Export growth remains low, whereas government and household consumption continue to grow, albeit modestly. Business confidence remains weak. The RMB BER Business Confidence Index fell to 21 points, while the ABSA Purchasing Managers Index rose to 48.1 points in October. The SABC Composite Leading Business Cycle Indicator also continued to trend lower. The forecast of GDP growth for 2019 is revised lower at 0.5%. The forecast for 2020 and 2021 have decreased to 1.4% and 1.7% respectively, due to lower growth than previously expected in the third and fourth quarters and downward revisions to global growth. The MPC assesses the risks to the growth forecast to be to the downside. Escalation in global trade tensions, geopolitical risks, further domestic supply constraints, and/or sustained higher oil prices could generate headwinds to growth. Public sector financing needs have risen, thus raising the prospect of further pressure on the currency and pushing borrowing costs for the broader economy higher. Implementation of prudent macroeconomic policies and structural reforms that lower costs and increase investment, potential growth and job creation remains urgent. The overall risks to the inflation outlook are assessed to be balanced, but uncertainty about inflation risks is unusually high. Demand-side pressures remain subdued, and house rental prices are expected to increase at only moderate rates. Global inflation should also remain low. Food price inflation has continued to surprise to the downside, but rising imported food prices and uncertain domestic weather patterns raise uncertainty about the future price trajectory. Further upside risks to the inflation outlook include wage growth and fuel, electricity, and water prices. The risk of further capital flow volatility has also increased, which could put pressure on the exchange rate. The MPC welcomes the sustained moderation in inflation outcomes and inflation expectations, and would like to see inflation expectations anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC decided to keep the repurchase rate unchanged at 6.5% per annum. 3 members preferred to keep interest rates on hold, and 2 members preferred a cut of 25 basis points. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interests of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period, generated by the quarterly projection model, indicated 1 repo cut of 25 basis points in the 3rd quarter of 2020. This remains a broad policy guide which could change in either direction from meeting to meeting in response to new developments and changing data and risks. That concludes our statement, and we at this stage would like to take any questions that you might have, and the panel here would deal with your questions. You will also find attached at the back of the statement the dates for the MPC meetings for 2020. Who are the early takers? Yes, sir.
Good day, Governor and the panel. I'm Mfoneko from Reuters News. I wanted to ask, was the upcoming February budget a consideration in terms of timing of the decision? Second question is, how much of a consideration was the fact that other emerging market banks have been cutting rates and perhaps cutting them aggressively, and that obviously has an impact on the attractiveness of the yield offered by South African assets? How much of that was a consideration in your discussions? Thanks.
Any other? Yes, ma'am.
Governor, it's Pranesha from Bloomberg. Also just want to get some insight into your discussions. The MTBPS showed rapid deterioration in the fiscal outlook, and we're also a step closer to a full house of junk ratings, with Moody's having changed the outlook. How did that factor into your discussions?
Yes, sir.
Good day, Governor. Lucanio from Business Day. Governor, seeing that the inflation outlook this year was so much lower than what we were predicting this time last year, how concerned are you that policy today might be based on forecasts that might turn out to be wildly maybe pessimistic, maybe like we might have more room than maybe you think?
Yes, ma'am.
Governor Hilary Joffe from Business Times. You continue to emphasize that you are guided by trying to get inflation expectations down to the midpoint of 4.5%. So 2 questions. The first is, are you convinced that expectations are a major factor in shaping inflation, the inflation outlook? Is there a sort of a direct correlation? And the second is, have you considered asking the Treasury or the Finance Minister to change the range to a point target of 4.5% to clarify what some would say already is the target?
Thank you very much. But still, Mfuneko, your question is also related to what Prinesha had raised in terms of the budget and in terms of the MTBPS. We don't know what is in the February budget, so there was no way in which we could factor it into the decision today or factor it into future decisions. We do not know what is in that budget. But Prinesha asked the impact of the MTBPS, and very clearly the fact that the rating agencies had reacted in the manner that they had reacted suggests that they have concerns about the MTBPS. If the rating agencies have a concern, those will then begin to factor into the country risk premium. And the manner in which we end up having to decide what the neutral rate is for South Africa is that we take what the foreign neutral is and we adjust it for South Africa's specific country risk. And clearly, if the South African country risk rises, then what you have is that neutral rate is then deemed to be higher. And if it is deemed to be higher, that suggests that where you are sitting in terms of the ruling stance, it could suggest that you are more accommodative without becoming accommodative yourself. It's purely a shift in the country risk premium. Put simply, if this country is to bring down the long-term cost of capital, we have got to bring down the country risk premium. And we have got a history with that. We know when we were in a good space and country risk premium was low, the cost of capital in this country was always lower. Was Moody's a consideration, as we had said? It's what the agencies had to say and what that could fit into the country risk premium that will fit itself into the neutral rate. Was it a factor that other emerging market banks are cutting, and thus it changes the relative rates between us and those countries? We always look at what is happening in South Africa's major trading partners. But what feeds into our neutral real rate in the main would be the neutral rates of the G3 economies, being the US, the Euro area, and Japan, for example. But even when those central banks move their policy rates, we do not try and match them basis point for basis point. What we do is to analyze developments in the South African economy and what the changes in policies in those other countries mean for capital flows in South Africa, and by extension what it could mean for the exchange rate. And we then have to take a view as to whether that is a once-off move, and if it is a once-off move, we see through it. And if it is not a once-off move, and it ends up fitting itself into domestic price formation process, then policy has got to react to that. And it could be that the shock is good for inflation, meaning it brings inflation lower, or it could be that it is adverse for inflation, meaning it raises inflation. That is how the transmission from developments elsewhere in the world get taken into account in our deliberations. And of course, we look at inflation because that's what says it. But it also has an impact on competitiveness, and that by extension also have an impact on growth. And we have got to take account of those. Why do we have to take account of growth? We've got to take account of growth because our responsibility, our mandate is in the interest of balanced and sustainable growth. That's one. And secondly, is that the output gap is a very important input into the domestic price formulation. And for us to know what the output gap is, we have got to know potential, and we have got to know what we expect growth to be in the future, because you do not determine policy on the basis of today's indicators, but on what indicators are likely to evolve into in the future. Simply put, what would be the outlook for both growth and for inflation? Lucanio, inflation surprised on the downside this year. In the monetary policy review earlier in the year, we did a study and a comparison of what our forecast was at a particular point in time and what the ultimate outcome was. We compared ourselves to all the other forecasters in the economy. The bad news is that we were all wrong on the forecast relative to the outcomes. The good news are we were less wrong than the others. We took it further and we said, what happens with other central banks? And we compared our forecast relative to the outcomes and say, what is the deviation? And what has been the experience of other countries? And we were within range. So let's get things clear. The reason we keep on emphasizing data dependency is because as data evolves, it changes your outlook, and by extension also changes what you are going to do. And if you make the wrong call, you might find yourself that with hindsight, you say, oh, I could have done something else. But as we know in life, hindsight is perfect. You can never get things wrong with hindsight. So when there had been a deviation, we then try and go back and say, what caused the deviation? And by a big measure, it had been food prices, which kept on surprising on the downside. There had been other factors like owner equivalent rent and so forth, but by a big measure, it had to do with food prices. Hillary. Inflation expectations and whether we are convinced as to whether they are shaping the inflation outcome. There is no doubt that they do. The academic literature and the evidence is compelling that there is a very strong relationship between expectations and inflation outcomes. There is a caveat, and the caveat is you have got to take a view about whether the inflation expectation formation is rational and forward-looking or whether it is adaptive. If inflation expectation formation process is forward-looking and rational, what it would mean is that the price setters in the economy look at what future inflation is going to be, and based on what they think future inflation is going to be, they set their prices accordingly, whether they are labor market participants or product market participants. And in that process, monetary policy also becomes fairly easy because it's just so straightforward. All agents look at it this way, and put simply, we then talk of the anchoring of expectations going forward. But that anchoring could be an anchoring around what the central bank wants, or it could be higher than what the central bank wants. It could even be lower. That is not a big problem from a policy perspective. You can deal with that. The problem from a policy perspective becomes when they are de-anchored and they are all over, because then that makes the policy decision process complex. The expectations formation process could also be adaptive, which means that economic agents set their prices based on what the most recent inflation rate is. And if that is the case, if inflation is going up and the price setters are adaptive or backward-looking, then you are going to see a spiral in prices, because as the price outcome is published and they see that it is higher, they then adapt to that and they go even higher. If it is that it is adaptive and inflation is going lower, that could be beneficial, because that would mean that they look at the most recent inflation outcome, and the lower it comes, the more they set their prices lower. In South Africa, the jury is still out as to whether it is forward-looking or backward-looking. And in the quarterly projection model, what we do is that we give an equal weighting to backward-looking expectations and forward-looking expectations. And we blend that, and on the basis of that, we generate expectations in terms of the quarterly projection model. Would we consider approaching the National Treasury to change the target from a range to a point? And I like the fact that you said approach, because it's got to be an iterative process between the two institutions. Since the target range was set, many countries around the world have revised their inflation targets. None of them revised it higher. They all revised their targets lower. It is also true that our range is wider than that of other inflation targeters, and might even be on the higher end of our peer countries. Most countries use a point, but there isn't evidence that suggests that a point is better than a range. And in any case, many countries that have a point that will say it's 4.5%, that is our point, plus minus 1.5%. So if South Africa was to have a point of 4.5 plus minus 1.5%, it will be 3 to 6. It amounts to the same thing, but the point does get people focused, because they say that is where they want it to be. We haven't thought of having to approach the Treasury to change to a point as opposed to a range. What the range has done for us is that it has given us the flexibility within the range. We were able to aim for the 4.5 within the target range of 3 to 6. And we are actually pleased that increasingly the analysts and the price setters are starting to talk about that midpoint of 4.5%. And if it is sustained, it will be a welcome development that could actually give a respite to the price formation process in this country.
Well, there you have it, certainly. Breaking news this hour, the South African Reserve Bank's Monetary Policy Committee deciding to keep interest rates on hold at 6.5% for the repo rate, the prime lending rate then to remain at 10% at least until the 16th of January. That 3.7% inflation rate to have come out yesterday for the month of October, according to Stats SA, not enough to persuade the South African Reserve Bank as the split vote goes 3-2 for a hold in interest rates. We'll unpack all of the details right after the short break. My two guests, of course, are also with me, and we'll get to chat to them about their thoughts right after this. Do stay tuned.
Here's a minister who says, I'm working on some sort of plan.
There's no way that we can agree to pay workers less wages. There's no way we can agree to domestic workers being paid less than what they currently get. We can't agree to farm workers being paid even lower than the slave wages they earn right now.
What is the role of lawyers in the fight against corruption in the country?
We've seen lawyers who knowingly that this client or who would have a reasonable apprehension that my client could be paying me from proceeds of the crime. I think it's about time that we legislation somehow considers how to discourage that type of conduct by lawyers themselves.
Where are the gaps as a person who has thoroughly interrogated the 4IR space and how it will have impacts on the country?
One of the unfortunate consequence of the fourth industrial revolution is the possibility of increase in inequality.
Welcome to our special broadcast of SA Today. Of course, the South African Reserve Bank's Monetary Policy Committee having just released its thoughts on the South African interest rates, keeping on hold that repo rate, 6.5% for the repo rate, 10% then for the prime lending rate. Let's immediately get the thoughts then of our guests. And this afternoon, I'm joined by Mahlodi Matseo, who is FNB economist, and Owen Nkomo as well from Nkunzi Wealth and Investment. Folks, thank you so much for the time. Mahlodi, let me start off with you. Surprise? No surprise?
So it was both a surprise and not a surprise for me from a few aspects. So our expectation was for a cut. And I think if one looks at where the SARB is with its repo rate at the moment and their inflation forecast relative to ours, we were essentially saying that we expect a cut because if you look at the real rate, the real repo rate, we felt that from our perspective, it was high enough to accommodate this risk premium that the governor keeps talking about. So my expectation at least was that on the inflation front, they would cut their forecasts, which would then have given them room to cut the rate. But if they kept them unchanged, then it makes sense that they didn't cut their repo rate, because then that means they keep sort of a similar level of the real rate that they had, and the sensitivity of flows that he was talking about then is catered for.
Did yesterday's inflation figure shock you though?
No, so it was exactly in line with our expectation. We had at 3.7 and it came out at 3.7.
Jeepers, you guys are very optimistic then, if I can put it that way. I don't know, optimistic or pessimistic. Owen, surprised?
Well, disappointed.
That makes two of us.
I really think that, given the inflation numbers that you've just mentioned, the numbers coming at 3.7%, our lowest level in over 8 years, and given all these negative, indicators that he was driving towards, or rather he was highlighting as he was reaching towards the announcement of the decision, I almost thought that he was going to reduce interest rates. And I think it would have been the more prudent approach, in my view, given the struggles the economy is having, given this high unemployment and given a whole lot of other things. But it necessarily is not so simple, Arabile, given some of the factors that the governor has given us. Is considering a whole lot of things. And I think that he's probably concerned about the ratings decisions and its impact on the currency in the next few months. And I think I've realized that he always acts ahead of time. We're thinking about things happening today, but necessarily he's acting, thinking about what's going to happen 12 months to 18 months from now. And probably he's seeing a different picture than we're seeing even despite the desperate environment the economy is in at the moment.
I know it's not the only thing, but it is one of their primary elements, and that is price stability. Is that still the mandate, though, considering what we've now just been told? Because what I feel came out of this was more about geopolitical tensions and geopolitical issues, and fine things like the credit rating as well. But those factors certainly became a whole lot more prevalent in this statement than possibly before.
Yes, I mean, you talk about geopolitics, and then he's mentioned South Africa's country risk more than 2 times in his conversation today, and even when he's talking to the journalists that have asked him questions. You know, it's important to realize that, you know, as yes, they might have formulas, etc., that we expect them to stick to, but then obviously, you know, managing a country's finances is a dual structure, or rather, there's a dual approach where you managing the monetary side of it and the fiscal side of it, which is we're just discussing earlier with Matlodi, that it's, you know, the fiscal side is not looking great. And unfortunately, that takes away the leverage he might have had to cut interest rates. If there was more discipline on the fiscal side, which I think we are far from where we really need to be, and we're actually building on more baggage on our fiscal finances, I think it makes it really difficult for him to just look at the one side of these 2 coins and say, because this one coin is working because of lower inflation, let me cut interest rates. I think he needs to go and talk to his colleagues in Parliament and see if they can, you know, up their socks and take care of the fiscal side of things.
Matlodi, do you agree?
Yes. Well, I mean, if I think about it from their framework, right, I do still think you can call them, you can call their mandate that of stabilizing prices, right? Because the country risk elements that he speaks of, those elements actually will ultimately influence the rand, which ultimately has an impact on inflation. So I would say yes, the mandate is still intact.
You know, I want to put this out there and just say, so at 3.7%, it's historical CPI. And we know that that's not necessarily what they look at, because they're looking at future intentions here, right? My question, however, is that you said that you'd like it to be sustainably at 4.5% or thereabouts in the long term, right? You've had it there since December last year. Yes, you've cut interest rates once, and that was in July. You've been given an even lower interest rate. If the things that you deem as risks do come to the fore, are you then not saying to yourself that we've got enough in the enough room that things won't get out of control? Is that not perhaps a thought process here? Or is that just the thought process of 2 out of the 5?
So I think a lot of that has to do with inflation expectations and anchoring those as a lead to actual
They've been
inflation.
wrong for almost a year now on those.
I know. I know, but I think perhaps another thing that they're waiting to see is, so they're expecting inflation to peak during the first quarter of next year, right? So I think they're perhaps also waiting to see what inflation expectations are going to do in that period. If they tick up and they no longer go down to that 4.5, then they might, you know, bring the narrative.
Would you not have missed a chance, though? Would you not have missed a chance to, and look, again, you could have cut by 50 basis points here if you were really, really Tito Mboweni-esque, if I can call it that, right? But because you're conservative, you're allowed, you know, a quarter basis point, surely just enough to, and I'm not saying it's going to be the panacea for growth. That's certainly not what I'm saying. But in an economy where consumer confidence is at its, you know, at its wit's end. Business confidence is certainly at its wit's end. It's not going to change everything, but it could do something, particularly in terms of confidence. Is that not what we could also be looking at?
It is. I feel like I am trying to defend.
I'm showing off exactly what I wanted in the NPC.
I feel like I am trying to defend the SARB, which I am not trying to defend the SARB. I guess I'm just trying to understand where they're coming from. So yeah, I mean, the only thing I can think of going forward as well with inflation expectations, not inflation, is if they tick higher in the first quarter of next year, then they might bring forth the narrative that they're still expecting them, well, they would like once again to see them going lower and stabilizing towards the 4.5. So they want to make sure that inflation expectations are anchored as well. So let's see, when inflation peaks at 5% in the first quarter of next year, if expectations move higher, then that might also not be good for us. We'll be sitting here having this same conversation.
Owen, your biggest risks, and I will bring you back if he doesn't, eh? Owen, your biggest risks?
Look, I mean, I think like he mentioned, the geopolitics, and by that, he's just basically talking about China and America, where these two countries, particularly I think because of Donald Trump, are failing to find each other in terms of what they do with their trade war that's currently going on.
Yeah.
And obviously some of these Middle Eastern issues that are happening in terms of potential wars, you know. I do think that those are some of the concerns to look at. But what's a big risk in my view is we potentially are going to start to see more rhetoric around how the SAB is not looking closely at the fact that people are losing jobs and things like that.
Yeah.
You know, it's easy for the man in the street to say, how come he's not cutting interest rate when we're losing jobs and the GDP is not growing and things like that? They potentially are being too mechanical and too
I
statistical.
certainly want to touch on that one. It's actually very, very important, and we'll touch on it right after the short break, and we'll go straight to that right after this. We are going to a short break now, but of course, that breaking announcement then, of course, the South African Reserve Bank, perhaps unexpectedly or disappointingly, keeping interest rates on hold at 6.5% for the repo rate, 10% for that prime rate. We'll be back for more right after this.
Many often share their worry about artificial intelligence taking their jobs away. The truth of the matter is that artificial intelligence does a lot of things faster and better than humans.
That machine didn't make itself, it was made by a human being. So which means us as human beings, we need to think more on the skills which we have.
I feel like ultimately it'll increase productivity and efficiency of things.
There was a lot of apprehension from the staff. You know, the staff is really worried. You know, what's going to happen? Am I going to lose my job? Is machines going to take over the world? The reality of the matter is, though, that the future is a blend of humans.
I don't like the sound of it too much. The fourth industrial,
On Network every Sunday at 8:30 p.m.
Welcome back to our special broadcast then of SA Today as we continue to unpack that monetary policy announcement from the South African Reserve Bank, keeping interest rates at 6.5% for that repo rate, an unchanged stance as well for the prime lending rate at 10%. Matlodi Meite from from FNB joins us as well in studio, as well as Owen Nkomo from Nkunzi Wealth and Investment. Owen, before the break, we were talking about how perhaps this is something the unions could jump on, for instance, that you have this dire situation for South Africa's economy and you're not helping us one bit. We certainly must then change your mandate.
Oh, yes, most definitely. I promise you, somewhere right now, a union member is talking to a journalist and they are very angry that the interest rates have not been cut. And I think, like I've said on the show, it's not that simple. There's a lot of things to be considered. There's a lot of interested parties, but I believe that given where we are right now, where the country needs to make decisions that can assist the current economic metrics, we need to be thinking broadly, in my view. Don't necessarily change the mandate of the SAB, but I can see if you were to ask Mr. Khanyago that question right now, he would say, this is my job, I'm doing what I'm hired to do.
Yeah. Is that not too mechanical though?
It is, and I think that's why unions might not take a liking to this, and the politicians as well, because I mean, month in, month out, the indicators are just piling on negative stuff. But like I have said, as a country, holistically, the people in charge of the country, the politicians in charge of the country, particularly the Minister of Finance, we have a bigger conversation in terms of driving the reduction in the fiscal deficit, in the budget deficit in the country. And I think that one could create room for interest rates to be reduced. But right now, if things go west, think about ESCOM and all these challenges, downgrades that might be pending, and interest rates going up, our fiscal metrics is going to worsen. It is already difficult for us to justify any expectations that things are going to be managed anytime sooner, given the mid-term budget statement. I don't know what your views were there, Matlori, about the mid-term budget statement. I don't think we were aggressive enough to say we need to really talk about cutting hundreds or of billions.
Necessarily put a plan in place, right? We laid bare what our problems were, but it wasn't necessarily that we said, here's the plan then. Here's exactly how we're going to find the 150 billion that we need over the next 3 years, for example.
And this is how we're going to cut unnecessary expenditure, by dealing with corruption. If you don't fix that side of things, it's going to be harder to manage the side. And like I said, the unions are just going to jump on the bandwagon, and to an extent, justifiably so.
Yeah, Masori, your sentiments as well, same with regards to this?
Well, so I think one of the key things that was a disappointment for me in the budget was, I don't know if you remember, in February they made all those expected cuts for wages in particular, etc. So that was a bit of a shocker for me when I saw it in February, but to see them reverse some of that now, that was disappointing. So yeah, I'm not sure. I think that with the fiscus, we need to rather focus on that and maybe ask these questions.
Yeah. Look, one thing's for sure is that the policymakers, that's government, of course, right, need to stand up right now and realize that it is a lot of their fault that we are sitting in the current situation. How are they going to fix it? How are they going to make things a whole lot better, whether it be in reducing debt? And I really think that you start off by reducing debt. A lot of other elements can begin to take care of themselves. And it becomes harder then for Lesotho Kganyago to make the decisions we perhaps would like him to, you know, in a scenario like this. But at 2-3, or 3-2, should I say, when it comes to this vote. 3 deciding on the hold, 2 of the MPC members voting on a cut. That tells you where the conversation went, though, doesn't it?
Yes. So, I mean, I was expecting to see that kind of split if there was no cut. And it does show that they had a robust discussion, because it means that even though there's this whole country risk premium issue, which they all agree with, they still did consider risks to inflation and more so downside risks to GDP, even after downwardly revising GDP growth. So, that's what I think it indicates.
How much did a downgrade in South Africa's credit rating play into the hands of this decision, you think?
How much did it play? I think to the extent that it does factor into elements that are part of this country risk premium calculation, it definitely did affect it. Because ultimately then it will affect where the rand is going. Yes.
I think Arabile, if you look at the currency, in my view, I highly doubt that if we get downgraded in the next few months by the last ratings agency that still has us at a relatively decent rating, I don't think that the rand is going to collapse, in my view. I don't see it going to 16. I believe that the market is already trading the currency and the country as if it was already downgraded. And if you look at some of the bond issuances that have come through recently, they've gone quite nicely. There was a big demand for the bonds, that were issued recently. And I believe that we might be potentially overpricing the South Africa risk element in this conversation as it happened today, because the global market, in my view, has already made those adjustments.
1488 at the time of the previous meeting is according to the MPC, and they say that the implied starting point for the rand, 1494. At present, it's at 1470. Before the meeting, 1466. Kind of tells you that there was not much movement with regards to this announcement having been made. Maybe it would have been a shock to the market had it actually changed in any particular way.
Say that again, the rand exchange rate.
Yes.
If it had appreciated.
Well, so if there was a cut in interest rates, perhaps that figure with regards to the rand would have altered quite significantly.
Yes, so it most probably would have fallen. Because if there was a cut, then you expect that it would have an impact on the real rates, which then affect the flows, and then we might have seen a few flows going out, leading to the rand depreciating somewhat.
Credibility intact still for the South African Reserve Bank?
I think so. Yes, they really are sticking to their guns.
Not if you're a union. But certainly, I think he spoke so well. He explained things nicely. He delivered well, and I think they are doing a good job. I think the challenge is that they've been put in an environment where, you know, the balance of forces is not in favor of them cutting interest rates. And as I said, everyone in the country needs to start coming to the table, to the party, and saying, listen, let's sort out our finances. You know, it can't just be the responsibility of the Reserve Bank. And I promise you that the unions are not going to be happy with this decision.
Do you think he had a firm conversation, though? Do you think he, and I know it's not his place to get involved in government politics, but when he gets spoken to, that's the Reserve Bank governor and the Monetary Policy Committee, do you think they make note of certain things and say to them, listen, for us to actually be able to do things a whole lot easier and make things a whole lot better here, you need to fix there? Do you think he puts a stern word in?
I think they do have those conversations, and I don't think that these politicians are not aware that they need to do that.
Yeah.
I believe it's now a matter of who's interested in what, in which part of the whole budget, you know. I do believe those conversations happen, and I think the biggest one, as always, is ESCOM. You know, how do we sort ESCOM out? And, you know, you've just said the drama around SAA, which is ongoing at the moment. The funding, if you can't find money to support SAA, a simple decision to make, which, you know, Titomboweni has suggested, is why don't we just think about privatizing some of these entities? But then some people don't want to do that because they're saying there's unemployment and now you want to close some of these state-owned enterprises and you're going to just increase that. But the problem is you're not looking at this thing holistically to say, if we plug these holes, we at least improve our potential in terms of avoiding, you know, continued plugging in of tens of billions of rands into supporting state-owned enterprises.
Is it government's job to have businesses, and what I mean by that, literally state-owned entities, or is it government's job to have the ability to administer, the ability to imply policy, to make business a whole lot easier, and let the businesses be run?
Look, I think it's a matter of things being done right. The government can have businesses, and they don't necessarily need to make profit, but they need to provide services to the populace that votes or lives in the country.
Yeah.
I think that if they just manage things properly, there's no problem there. So right now we're being pushed into a position where the government has no choice but to privatize. And case in point, Telkom was partially taken off the government books.
Example.
It's running nicely. And I think if you do that with some of these companies, I'll be weary to do it with ESCOM. I'd much rather get a private equity partner to participate there and make sure that the management is optimized. But with SAA, I promise you, maybe you fly SAA, I don't. So
I won't lie, I really don't either. And it's not because I don't like the airline, but I you know, and I suppose the assumption here is just that, you know, there are issues at SAA. It's not just that, but there's an element of fear.
It's an expensive national carrier.
It is.
It's expensive. You know,
it is.
There are alternatives, especially for people traveling locally.
That anybody else wouldn't be able to run it as a national carrier, as it actually is, as a flagship, right?
Yeah.
And I suppose that becomes one of the biggest fears. Very quickly as well, then, Matlodi, to kind of end off proceedings, he has an unchanged stance when it comes to the CPI numbers for the next 3 years as well, on average. 4.2%, 5.1%, 4.7%. If all of those ring true, then he would have been justified to keep interest rates at their current level, wouldn't you?
Yes, but if he had cut those CPI numbers, then the probability of a cut would have been much higher.
Would it have been out of control, though? I mean, look, 4.2% for 2019, maybe that goes up to 4.5%. 5.1 goes to 5.3. You then bring that back, hopefully quite substantially at a later stage, and you come back to around 4.5, 4.7.
He makes it sound so easy.
I know, it's really not, right? It's really, really not.
Yeah, look, I think it's not easy.
Yeah.
It's not an easy, it's not easy managing the finances of a country that is in trouble in so many ways. So it's a difficult balancing act.
It is.
Yeah, but I think we need to be making difficult decisions, Arabile, and I think our leaders are failing to take that
and not
plunge.
just the Sechakhanyago. We're not talking about specifically just this, but we're talking about all our leadership.
we need to be making quick
decisions there.
Yeah.
But back to inflation, just mark my words, or rather do not lose hope. I think their CPI forecast will come down slowly. They've been a bit on the upside, and as they keep downgrading our GDP outlook, the CPI is going to follow.
Sure.
And then we might see cuts.
Okay, well, let's see what happens, folks. Thank you so much for the time, Matlodi. Really great having you. Please do come back, the both of you. Really appreciated having you on set today. Matlodi Matsie, FNB economist, and Owen Nkomo from Nkunzi Wealth and Investment, giving us just their thoughts then on unpacking the detail as the South African Reserve Bank decides to hold interest rates, 6.5% for that repo rate, the prime lending rate at 10%. We'll do this again on the 16th of January. That was the last MPC meeting for the year. So, of course, we'll give you all of that as and when it comes. SA Today continues at the top of the hour with my colleagues there, Peter Ndoro and Palesa, of course. Do stay tuned. This is SABC News.
We've been all around the country talking to real South Africans about saving money on their car insurance. Let's meet some of them.
My name is Jacques, and I save 403 Rand a month with OUTsurance. My wife made it happen. I'm a bit of a procrastinator. She nagged me and nagged me. Phone OUTsurance, get a better quote. I will definitely take her out for a little something special. As a salesman, seeing how OUTsurance does business and the way they treat their customers, I would very much like to take the example and teach that to my salespeople as well.
If you think it's a hassle getting a quote, put us to the test. SMS SAVE to 34473 or call 08600 60,000 to see if you can switch and save. Do it now.
My name is Yvette and I save 1,250 Rand with OUTsurance. I was downstairs and my husband came down and he told me about OUTsurance. Then we can pay less than half. I can't believe it, and I just hug him and give him a kiss, and I said, that's great. I've got that car 5 months now. It feels like when I'm in that car and while I'm busy driving, I don't want to stop, just want to keep on driving.
If you haven't called around for a quote in ages, do it now. SMS SAVE to 34473 and see if you can switch and save.
My name is Rita and I save 508 Rand per month with OUTsurance. I am a bookkeeper, so I keep a tight rein on my finances. This is going to help me do more of the things that I like to do. Painting, a little bit of wood carving. My car means the world to me. I've had her for 14 years. I feel like $1 million when I'm driving around with it top down. It really makes me feel good.
Real clients, real savings. Don't overpay for car insurance. Put OUTsurance to the test today. SMS SAVE to 34473 or call 08600 60,000 to see if you can switch and save.
My name is Bakepi. I saved 918 Rand a month with OUTsurance. I couldn't believe the guy. I thought maybe he was just pulling my leg. So I'm a teacher at Karl Malcolm High School in Kokstad. And the lesson I'm giving to you, if you feel you're paying too much, means you are breathing through the wound, contact OUTsurance.
If you've been with the same insurer for years and haven't recently put OUTsurance to the test, SMS SAVE to 34473 and see if you can switch and save. Do it now.
My name is Pearl and I save 929 Rand a month with OUTsurance. I'm an extremely busy person. I run a few businesses. When I need things done, I need it quickly. And that's exactly what OUTsurance gave me on my first call. It really made it easy for me. I can definitely use that money to save for a holiday or even save for putting back into my business. I'm going to definitely recommend OUTsurance to my clients and make sure all of them switch and save.
Real clients, real savings. They've all saved. Why shouldn't you? SMS SAVE to 34473 and see if you can switch and save. Do it now.
My name is Zenefin, and I'm saving 372 Rand a month with OUTsurance. I saw this ad on social media of OUTsurance. I replied to it, and I got a call almost immediately. I'm a scientist, and I had so many difficult questions, but he had all the answers. I saw this amazing saving